back to MMG. So this video might actually be one of the most important videos, or the most important video. We're going to find out soon, in the next 3 to 4 weeks. So, as you guys know, for the past 3 weeks, I've been saying the markets are overdue for a correction, even though they hit new all-time highs. At least a pullback or something, right? Pullback, correction, you name it. And basically, that's based off of TA and momentum. All right. So this is the S&P 500 6-month chart. Each candlestick represents 6 months. We're on a 9 sell signal with my TDI indicator. And all oscillators are extremely overextended on the 6 month. So, and it's been pretty accurate. So if you backtest this, the 9 sells have pretty much predicted the last 2 recessions. And I'm fairly confident this one's going to predict this one. But that gives us a window of 6 months. So I've also been saying for weeks now that sometime in 2020 we're going to get the big one, the big correction. It could be the beginning of the bear market for a very, very long time. Who knows, right? Many years, maybe a decade, just very long decades. You know, the end of this entire century of the markets going higher and, you know, the U.S. capitalism, all this. All right. And, you know, the central banks and the money print, it all comes to an end in like the next 6 months, which is a pretty profound statement. I know. I give it a 70% chance because the Fed could still always come out with QE 4, 5, 6, 7, 8 and make the stock market go higher, but that doesn't matter. The stock market could actually keep going higher while the real economy is in a Great Depression. And that's what happened in Venezuela, right? Because nominally, all of that funny money, monopoly money, goes into the stock market, right? And it can push stocks higher and higher as people chase for yield, but inflation outstrips it, and then when you sell your stocks, it's not going to matter. And someday, eventually, it's still going to crash anyways. But that's the huge melt up. I feel like we're already in the melt up phase right now. It's also very euphoric. Everyone thinks the Dow and everything's just going to keep going up. I can see it even in my own chats, and people at this point have become complacent and they just think this time's different. I'm already getting a good sense of that. All right. Now, I'm going to read this article by someone who's way smarter than me, who's actually done something in this world, who actually created the repo market. Okay? And this is a big deal. Very big deal. So this is going to get a little heavy. It's hard to understand. I'll try to explain it. It's even hard for me to understand, but I understand it enough. All right. And, you know, for the past few months, I've been saying, I mean, something broke. This is the canary in the coal mine. You know, when the canary dies, a live canary in a coal mine, it means there's gas. And that means you need to get out of the coal mine because there's poisonous gas. That's where the saying comes from. So I think the repo market is the canary in the coal mine. Now remember, in 2008, right before the markets started dumping and Lehman Brothers went under, the repo market started breaking and spiking the interest rates on overnight lending for the repo. Well, the same thing's happening right now. We just haven't had our Lehman moment. And is the Lehman moment like right around the corner? According to this guy, yes. Like Monday next week on the 16th. Today's the 11th, December 2019, for record. All right, this is a This is by Durden, Zero Hedge article, right? It's about to get very bad. Repo market legend predicts market crash in days. In days. All right. So when someone says in days, that means they have to be very confident because now they're putting their reputation on the line and they're telling the world. And a lot of people are listening. A lot of people read this. Even the Fed. People who work at the Fed read Zero Hedge. It's funny. And I've talked to them at bars. Believe it or not. Like people who work. Anyways. So when someone says that, they have to be very confident and they're putting their reputation and everything on the line, right? Also, this guy's Hungarian, so he's a realist like me. Legend. All right, anyways, let's get into it. For the past decade, well, before I do, I need to show myself. Go to my website, MMGinvest.com. Watch that video. Recently, I found a pretty awesome ETF. Like, even a layman, a person who's not like has much experience with stocks, you could technically buy an ETF that's not leveraged. And if it's very well managed and it has real good assets in it within it, because an ETF holds a basket of stocks, right? Like a basket of mining stocks, like gold and silver mining stocks, right? And this one's brand new. I didn't know about it, and I found it, and I'm pretty excited about it. What I'm trying to say is, you could just buy an ETF, and it's managed for you, and there's fees, right? But you don't really have to do anything. You just buy it and hold it through the bull market, and then towards the top, you start selling it off, right? Scale out of the position, and then you go buy real things in the real world, or build a business. Take that capital, turn it into a revenue stream, so you can survive the rest of your life or something, or buy apartment building, or rent out homes, whatever, right? That's my plan, not financial advice. Now, what I'm trying to say is, a lot of people I know for a fact, because I see them in the chat groups, they think gold and silver is going to crash when the stock market crashes. And yes, it might. But in the beginning, it rallies for a few months and then it crashes. That's what happened last time. And I honestly don't know what's going to happen this time. I'm prepared for whatever happens this time, and I'll act accordingly. But let's say the market does start really tanking, like in the next few weeks or months. Metals are going to go up. They're gonna come out with QE, right? QE 4, 5, whatever. And metals are going to go up a lot. I don't know how much they're going to go up, but what I'm trying to say is the manipulation's over with. And maybe years or maybe even a decade or two of pent up price suppression is going to explode in a very short period of time. And gold could go to like over 3,000 in the next like 6 weeks. And then it eventually will correct and crash with the market as people have margin calls. But then where is it going to fall back down to? 2,400? Right now the price is at, I don't know, it's at 1468 right now. So let's say the market starts dumping in the next few weeks or months. Then it rallies to 2,700. I don't know where it rallies to. And then finally the margin calls kick in and everyone's getting liquidated. And then the metals prices fall, and so do the stocks. The spot price, the physical price, that won't fall though. I'm talking about equities. And then you'll get the correction in equity prices, right? In the mining stocks and the ETFs and futures. And then it rebounds and goes to the moon. Like 5, 7K, wherever it's going. I don't know. I'm not a prophet. So waiting for that it might not work out for your benefit. Or it can just, maybe metals will fall with everything else from whatever, 1470 or wherever the price is right now, right? either way, I'm bullish for the short term for the next few weeks and months. So there you go. That's not financial advice. I just I did my TA video. My last video was my TA video. All right, let's get into this article. Oh yeah, 15% off until the end of this year. Go to my website. The link will be in the description section below this video. You have to click that link to get the 15% off. All right, so let's start. For the past decade, the name of Zoltan Bazar has been among the most admired and respected on Wall Street. Not only did the Hungarian lay the groundwork for the current understanding of the deposit-free shadow banking system, which has the often opaque and painfully complex short-term dollar funding and repo markets at its core, but he was also instrumental during the tenure of both the U.S. Treasury and the New York Fed in the laying the foundation of the modern repo market, orchestrating the response to the global financial crisis and the ensuing policy debate, as virtually nobody at the Fed knew more about repo at the time than Bazar. Serving as a point person on market developments for Fed, Treasury, and the White House officials throughout the crisis, yes, Kashkari was just a figurehead, playing the key role in building the TALF to backstop the ABS market and advising the former head of the Fed's market desk, Brian Sack, on just how the New York Fed should implement its various market interventions without disrupting and breaking the most important market of all, the multi-trillion repo market. In short, I'm just going to call him Zoltan. In short, Zoltan speaks, or as the case may be writes, people listen and read. So people do listen to him, and he is, a credible source and a big name. And since Zoltan moved from the public sector to Credit Suisse in February 2015 to write his market moving, at least for those who can understand it, periodical Global Money Notes, it has been relatively easy to keep track of his thoughts and observations on the repo market as they change over time, which brings us to his latest Global Money Notes, number 26, published overnight, and in which Zoltan delivers his scathing assessment of the Fed's latest intervention to stabilize repo markets since the September 16 repocalypse that sent overnight repo rates as high as 10% in what was previously seen as an impossible event. You guys need to understand that the repo market moves like under 1%. It never goes, it might go 1%, but nothing like that. All right, 10% is insane. It's not supposed to be that volatile whatsoever. This is overnight lending. Like, you get a fraction of a percent for lending someone cash for like a week or two that the banks do for each other. They lend money to each other. Like, one bank's doing great, they do more lending. When the other bank needs cash and they don't have the reserves, they get it from another bank. Of course, as we see 3 months ago, not only was the event possible, but it led to a shockwave of confusion as to what caused the prompting of even the BIS to chime in on over the weekend with a fascinating theory discussed previously that hedge funds were among the causes for the repo fireworks as they scrambled to procure funding to prevent their massively leveraged relative value trades in which they bought treasuries and sold equivalent derivatives contracts from collapsing. All right, so while Zoltan does not focus as much on causes of the repocalypse, having previously covered them in depth in his prior money notes, and he would know, as noted above, Zoltan is the de facto architect of the modern U.S. repo system. What he does do in his latest note, titled ominously Countdown to QE4, is explain why the Fed's interventions to date have failed to reverse the underlying plumbing issues in the banking system, manifesting themselves in dramatic increase in treasuries at the biggest U.S. bank, JP Morgan. So I have a theory before I continue. This is my personal theory. Maybe the U.S. Treasury because, their debts are exploding. Debts are exploding, guys. This is my theory before I get back to this article. So my theory is total assets of the Fed has been going up, right? Excuse me. And here's another St. Louis Fed chart. This is from the Fed, by the way, these charts. These are Fed charts. This is the federal debt, total public. It's been exploding, right? Since 2009 and 2010, right? And here's another article I found. Treasury securities, including a 20-year nominal. So the U.S. Treasury is looking to make longer-term bonds, 20 and 50-year bonds. And check this out. A 10-year Treasury constant maturity, the 10-year Treasury constant, the 2-year Treasury constant maturity, they've been ticking up as of late, as of recent. As you can see right here. Now, they did bottom out. Okay, I wish I didn't do that. As you can see here, the black line at the bottom here at 0, it bottomed out. And every time it bottoms out, that's like 6 months prior to 6 or 8 months, something like that, prior to the next recession, which is the gray areas, right? So these are the maturity rates. This is the yield curve. And we just hit that magic 0 line, which is near 0, the maturity rate, and it suddenly upticked. Now the same thing happened right prior to 2008 financial crisis, and the repo market broke at the same time. So there's 2 huge flags, red flags. That's why another reason why I think within the next 6 months, the music's gonna end. It's gonna come to an end. But it's gonna get crazier as I read the article. You guys won't believe it. All right, so, and my theory is, what if the U.S. Treasury needs more and more treasuries so they could pay out, all the employees on the teat and on the udder, and the debt's exploding. Everything's credit. All credit has is interest, and the federal budget is exploding. It's over $1 trillion a year now. It's getting close to $2 trillion, right? I mean, this past year, Trump's first term, the federal deficit has exploded. We just hit $22 trillion on the public debt. Just in the past month. Last month, or this previous month, we, what was the debt? Like $300 billion? I mean, it's $250 billion. And of course, the Fed is also doing the repo, right? And it's almost near $1 trillion for overnight lending, which is supposed to be temporary, but now they don't even talk about it being temporary. And they're supposed to mature, but now they're doing 14 and 28 day, and then in a few weeks they're going to be doing this permanently. You'll see. All right, what I believe. So let's continue. Also, I was looking at here's the Treasury, and I was looking at the bills, the Treasury issuance, right? I found this website, this company, and they have a spreadsheet on it, and it's been increasing with time. So on the left here is the date. This is like 2014, and it's been increasing over time. And that puts a lot of pressure on the repo market. And where's the liquidity going to come from? Are all these banks going to keep borrowing in treasuries or use it as collateral? You can't keep it going forever, right? That's why I say it's a Ponzi scheme. So let's get back to the article. So where was I? So here's the chart. JP Morgan sheds loans, buys bonds. And I've been talking about this in my last few videos. JP Morgan just pulled all their cash out of the repo market, started buying 30 years, right? So while Zoltan does not focus on much on causes of the repocalypse, having previously covered them in depth in his prior notes, and he would know, as noted, countdown to QE4 is explained why the Fed's intervention to date have failed to reverse the underlying plumbing issues in the banking system since the 2008 financial crisis, right? Manifesting themselves in a dramatic increase in treasuries at the biggest U.S. bank, JP Morgan. And they're buying 30-year bonds. There was another article on that a few weeks ago. All right, less firepower. Falling cash levels at U.S. banks means fewer dollars for repo lending. And as you can see here, the cash reserves have been falling. At the largest U.S. banks, something we addressed previously when we discussed how JP Morgan gamed the financial system to trigger not QE, and a topic that Bloomberg touches on overnight in repo firepower reduced by the falling cash levels at the big U.S. banks. So here's that article. And you guys, just plug in the title and you guys can find the articles yourselves. Even as hedge funds and smaller broker dealers lean more heavily on the biggest U.S. banks for borrowing in repo markets, the lenders, cash holdings have been declining, reducing their ability to jump in relative pressure when rate spikes. By the way, another collateral damage, right? Everything's so centralized because of central banks. Central banks printing money and credit creation has created monopolies, even with corporations and banks. And the last monopoly banks were bailed out because they're too big to fail. And all the smaller banks went under. And now you get problems like this. You have a couple monopoly banks, and they could do whatever they want, and they could trigger the next financial crisis if they wanted. Like JP Morgan here, right? I'm not saying they did, but, technically this can be doing that. So, and when all the banks rely on just like a few major banks, the systemic risk, it's just a giant. I mean, for one, that's socialism. We already live in socialism. It's just no one wants to admit it. Anyways, even the financial sector, there's no capitalism, guys. Because they were bailed out and now they hold all the cards, and that's not free market. There's no competition. In free market capitalism, there's competition. There's no competition. That's why we have monopoly banks that could do shit like this. All right. You guys can read the rest of this, but basically JP and the rest of the banks are calling for easing of regulations on top of all of this. Now, can you blame them for doing what they're doing? Technically not, because they're just looking out for themselves, but that's besides the point. So Zoltan cautions the core problem at the heart of the repo blockage is that banks shifted from owning reserves to collateral, mostly treasuries, for reasons we will address shortly. So when they talk about reserves, that means cash. And instead of holding cash, they're going to treasuries, like the 30-year and whatnot, which also made the yield curve unvert, and now it's, back to, it's normalized somewhat. But that's going to change. So U.S. banks like JP Morgan that are central to year-end flows spent some $350 billion in excess reserves on collateral since the beginning of the Fed's balance sheet taper, leaving banks and especially JP Morgan dangerously low on reserves. So their collateral is treasuries, U.S. treasuries, which is also funny because that goes back to what I said earlier, my own speculation that maybe Mnuchin and the Treasury needs more cash, like the federal government needs more cash to pay out all its debts and employees and the endless spending and the welfare and, All right. So, and while one can debate why banks shifted away from reserves to collateral, Zoltan has a simple theory. Dealers and banks loaded up on collateral as a trade they were supposed to be taken out by eventual coupon purchases by the Fed. In other words, here is a former Fed official admitting that banks were purchasing treasuries as nothing more than a QE front-running ploy, something which the Fed has previously sworn was never the intention behind QE. After all, if it emerges that the Fed is essentially facilitating taxpayer-funded and perfectly legal front-running, making bank execs even richer in the process, the U.S. Central Bank would have even fewer fans. And yet, here is arguably the most respected ex-Fed staffer. So Zoltan is an ex-Fed staffer, explaining that one of the core roles of QE is just that. So QE and these banks, basically JP and some of these banks, are front-running the fact that the Fed's going to do QE soon. And in a way, they're kind of forcing the Fed to do QE soon. And then, so by front-running it, they kind of force it. So it's the tail wags the dog when it comes to who's really running the show. Although, you know what's funny? I mean, the Fed is the banks. Who's the board of directors? It's all the other banks. So yeah, of course. What's the Fed's number one mandate? Price stability, employment, and keeping price stability is keeping inflation under control, which is exactly the opposite of what they're doing. But the real mandate is to bail out their own board of directors themselves. Anyways. And the other tool of the Fed is to keep the government funded and going so it doesn't have to tax the people like 99% to pay for things that the country cannot afford. All right. All the free shit, right? That you guys all want. All right. Alas, here the problem emerged. Because the Fed never did that, and for the first time, we're heading into a year-end turn without an excess reserve. So the banks aren't going to have cash going into the end of the year. Okay, indeed, instead of buying coupon bonds, and dealers have been quietly demanding behind closed doors a process which would allow them to sterilize their massive treasury holdings, the Fed announced in October it would only buy T-bills in order to not freak out the market that it is officially launching QE4. As a reminder, the only semantic distinction between whether the Fed is doing QE or not doing QE is whether it is soaking up duration. Which means is they're saying this is temporary, but they've been extending it for 3 months now. At first it was 2 weeks. It's the longest they're going to do this. Well, no, first it was a couple days, then 2 weeks. Now it's been 3 months, and now it's going to go on through 2020. So it is QE, and the Fed's balance sheet is growing. All right, the Fed's argument is that since bills don't have duration and it's not QE, however, once Powell starts buying 2-year, 3-year, 5-year bonds, and so on, treasuries, the facade cracks and the Fed will have no more defense that what it is doing is precisely QE4. And this is at all-time high markets, guys. It's insane. At least they're trying to get ahead of it. That's why they're doing this. They're trying to get ahead of the big, the next financial crisis, right? Because they're so scared to death. They know it's not the next financial crisis. This is the last one that's going to change humanity for a very long time. All right? And by buying bills, it is not allowing commercial banks to exchange their coupon holdings for reserves, cash, but merely results in recirculation of sterilized bill purchases. Recirculation of sterilized bill purchases. So yeah, I mean they're doing the repo thing, the POMO thing, the QE4 thing, and as soon as the previous repos mature, they roll it over and then they offer more to the banks, and then they take more and more. All right, now most people don't understand this and instead repeat the old maxim: don't fight the Fed, which they claim is adding liquidity through repos and bill purchases, and what's not in the system now will be there on year end, and the turn will be just fine. Okay, so this is MSN, right? Everyone's like, it's okay, and this is why the market also is going higher and higher. It's not just the lowering of interest rates, the Trump tweets, and the the euphoric comments and the recycled trade war narrative that gets the algos buying. What else it is the stock Wall Street thinks that the Fed now intervening with the repo market is injecting QE. I mean, Wall Street's not that stupid. They know it's QE. But they think that everything's going to be okay now because the Fed is doing that. And Wall Street's completely okay with it because, it pumps their bags. All right. Only as, what's his name? Zoltan says, not so fast, and explains what we need for the year-end turn to go well are balance sheet neutral repo operations or asset purchases aimed at what dealers bought all year. Coupons, not bills. The former to get around the foreign banks and balance sheet constraints around year-end, and that the latter of ensure that the excess reserves accumulate with large banks like JP Morgan. Unfortunately, the Fed is doing neither. All right. Central bank liquidity is useless unless primary dealers have balance sheet to pass it on, and that they've been passing it on since September does not mean that they will at year end. Bill purchases are also ill-conceived because banks and dealers don't owe any bills and so don't have anything to sell to the Fed to boost their excess reserves ahead of year end. In our view, the notion that bill purchases will force money funds down the yield curve to buy short coupons from primary dealers who would then pay off their repos with banks so that banks build up some excess reserves into year end involves too many moving parts. Which brings us to the first of the key observations made by, what's his name? Zoltan. Zoltan, since the Fed's repos and T-bill monetizations have done virtually nothing to boost prevailing reserve levels on the sustainable basis, year-end balance sheet constraints will preclude primary dealers from bidding for reserves from the Fed through the repo facility or through repos from money funds. The slope of money market curve suggests that excess reserves won't build up at banks, and so U.S. banks will not be able to fill the market-making vacuum left by foreign banks. So here's the thing. Foreign banks, you guys have to understand, because the dollar is the world reserve currency, and the U.S. has the biggest markets, the biggest banks, and whatnot. Well, actually, China technically has the biggest banks market cap-wise, but, they're, who knows. They really fudge their numbers there. So liquidity is getting sucked out of the banking system, and the banks don't have any cash reserves. So that's why there's been shortages at ATMs. I've noticed this in recent months. I go to the ATM, they're all closed. I can't get cash out. As soon as the Fed started doing the repo operations, there's freshly minted new cash in the ATMs. Although, of course, all fiat currency is mainly digital, but you guys know what I'm saying. Anyways, in other words, the already thin liquidity at year end. Oh, what I was trying to get at is with all of this QE and the world reserve currency status, this liquidity in the banking system isn't just U.S., it's global. And foreign banks are sucking up dollars so they can pay all their debt in dollar denominations, which brings me to the milkshake theory. Did I talk about the milkshake theory in my last video? I don't even know. Oh man, I'm not sure. I might have to. That'll be my next video. There's an update on the milkshake theory. All right. In other words, the already thin liquidity at the year end, which, as a reminder, last December 31st, sent repo rates soaring even though excess reserves were about $100 billion more than they are now, could get far worse as a result of the Fed's inability to properly address the reserves cash shortage plaguing banks. There is another reason why the year-end liquidity is likely to get far worse, and it has to do with bank year-end GSIB surcharges imposed by regulators on U.S. banks on the last day of the quarter and year. As we discussed 2 weeks ago, and as Zoltan explains, running low on excess reserves is only one factor that determines how bad the vacuum in the market making can get around the year-end turns. You guys can look at that on your own. But the bottom line is that the following banks seek as low as GSIB score as possible at the year end to minimize their period and surcharge. So their GSIB score is based on how much reserves they have, and the higher the score, the more taxes they pay or something, or surcharges they have to pay. This is like some serious banking stuff. Like I said, some of this you guys don't really need to know anyways. As Zoltan further notes, U.S. banks are particularly sensitive to their GSIB scores this year, as they all moved up to higher surcharge bucket due to bigger treasury holdings. Okay, so the more treasuries they hold, the more surcharges they get, and have a heavier repo footprint. Every U.S. bank except Morgan Stanley has an incentive to shrink its score into year-end. It is here that unique paradox emerges that highest stock prices rise. The higher the stock prices rise on the equity markets, the higher the implied score, a negative. Some more observations from the repo guru. So the higher the stock market goes, the more surcharges they have to pay, and they're holding treasuries, not cash, because they don't want to lend to each other, because they don't have the liquidity to do so. But it gets way more interesting. Just hold on. All right. The rally in equities is inflating scores through the GSIB market capitalization and value of the equities GSIBs hold as trading assets are available for sale securities. The flat yield curve is inflating scores through GSIBs, bloating treasury portfolios, which given auction supply and the equities rally may grow further into year end. While the GSIBs can't do a thing about the equity market, and as the largest primary dealers, they also can't not take down more treasuries at auctions if there are insufficient bids. So there's insufficient bids for the treasuries, but they can do two things to offset some of the factors that are pushing their scores up. Collateral upgrades, where they repo equities out to raise some excess reserves, or repo or outright sell some of their treasuries to raise some excess reserves. So they sell U.S. Treasury bonds to raise cash so they can meet the requirements so they don't get pinged with these regulations or surcharges. Clamping down on market making in the Forex swap sponsored repo markets, whereby they'd add to the vacuum in market making triggered by foreign banks. Which brings us to the other key year-end dynamic, which GSIB scores are too high and banks need to reduce them. They do so by swapping assets for excess reserves. In other words, when banks hold lots of excess reserves, their GSIB scores are relatively low and they have room to lend their excess reserves through repos and FX swaps. And conversely, when banks are low on so FX is Forex, guys. It's fiat currencies markets. When banks are low on excess reserves, the GSIB scores are high, and that may force them to clamp down on market making. Oh, it's a mouthful. Well, as we know from the discussion in the first part above, bank excess reserves have collapsed, and as a result, GSIB scores are high. And banks are lowering their scores by swapping assets for reserves to scrap together some excess reserves ahead of the year-end turn. And those scraps are all U.S. banks will have to lend into the market, making a vacuum left by foreign banks around year-end. So they're going to have to sell treasuries to raise the cash reserves, and this will create a vacuum in the treasury market. As for the worst-case scenario, it is one where collateral upgrades aren't sufficient. The U.S. banks stop making markets in Forex swaps, and so exacerbate that word. The vacuum triggered by the foreign banks, which brings us to the first Zoltan ominous conclusion. We are on track to realize the worst case scenario, and the market doesn't price for that. All right, some large U.S. banks are selling treasuries to lower their GSIB scores and scrap together some excess reserves to harvest the higher repo rates over year-end. Finally, and the most shockingly, the Credit Suisse strategist writes that at least one large U.S. bank appears to be pricing some of its Forex swap trades such that it misses those trades, a polite way of clamping down market-making activities. Here some readers may have a light bulb moment, because what Zoltan just described is that at least one large U.S. bank appears to be gearing up for a collapse in the Forex swap market with a very specific intention to force a market crisis in the coming days and force the Fed to launch full-blown QE4, not just a monetization of treasury bills. So, yeah, you heard that right. He said it, not me. All right, so JP Morgan might be forcing the Fed, but, you know, they're one and the same in my opinion. All right, GSIBs will retort to scale back market making like the one U.S. bank that's already pricing Forex swap trades to miss them. We do not see the pressure for this in Forex swap markets yet, as foreign banks still have balance sheet pickup and slack, but pressure will come as we get closer to year end. This literally means that no matter what the market does from now on until year end, there is simply not enough cash and or liquidity to allow the plumbing of the market to cross into 2020 without a crisis. Or Zoltan puts it, in our view, the Forex swap market is expecting too much similarity between the current year-end turn to last year's turn. That's a mistake, as last year's dynamics were different for the following reasons. By the way, remember last year, on Christmas, I mean, the market dropped within a couple weeks 20%. We almost went into a bear market. And that was almost the top to the stock market. But, you know, the PPT came in and they put a bottom into the market. And so did the Fed by starting to really loosen up and lower rates. One another key difference from the... All right, so one large U.S. bank still has excess reserves to lend. But this year, they do not. So last year, there was one large bank, which was JP Morgan. They got a GSIB relief from a 20% fall in equities, but this year, and they do not. So what they're trying to say is there's no banks with any reserves for this end of the year cycle, which could cause a vacuum and liquidity crunch, and the equities are going to definitely... I'll continue. Listen, towards the end of this article, you're going to learn something really important, so stick with me. All right, we're almost done. High demand for secured repo funding from non-financial institutions such as hedge funds heavily engaged in leveraging up relative value trades was a key factor behind the chaos, said Claudio Borio, head of the Monetary and Economic Department in the BIS. The BIS finding was novel and surprising that highlighted growing the cloud of hedge funds in the repo market, echoing notes, something we pointed out 1 year ago. Hedge funds such as the Millennium and so hedge funds, you know, last Christmas, end of year, we're having problems, so we're banks, and it's going to happen again. Except this time the repo market's broken, and JP is no longer the big whale market maker. It is likely that the RV community... I'm not going to talk about this. Benign and optimistic view currently prevailing among market participants is mostly related to the Forex swap market, given that excess reserves are gone, GSIB scores bind, in the Forex swap market, unlike last year, and may end up without a lender of next last resort, and so it will likely trade at implied rates for worse than anything that we've seen in recent year-end turns. Canadian dealers you expect to lend to you fund your bond basis trades and instead lend the Forex swap markets instead, and you'll end up short, and you may end up as a forced seller of treasuries. Excess reserves and dealers that have the balance sheet to take liquidity from the Fed's repo operations will not necessarily do repos with RV hedge funds if Forex swaps offer a much better value. So as they chase for yields, right, they might go into the Forex markets besides taking the repos or buying treasuries. In this dystopian world described by Zoltan, in which banks have too much collateral, treasuries, U.S. bonds, on their books and not enough reserves is cash, okay, where big commercial banks are unable to lend out to the rest of the banking system as they themselves don't have enough reserves, and where there will be an added pressure to boost reserves in the last days before December 31st, Zoltan's big picture conclusion is that the safe asset U.S. Treasuries is being funded on and therefore it depends on balance sheet to be held and printed. Balance sheet for the safe asset isn't guaranteed around year end, and if balance sheet won't be there and safe assets will go on sale, this is the big one. Translated, treasury yields will spike. All right, first of all, if they're so low on reserves, they're not even lending out and providing loans for the economy to grow and to continue to function, overnight loans. So if the banks don't have reserves, they're not going to lend money out to the public, and to the small businesses, mid-sized businesses. So, and, larger companies and all these mid-sized companies on the equity in the stock market, right, who have shares outstanding, they can no longer borrow money and they can issue corporate bonds for buybacks, but the buybacks are going to come to an end pretty soon as well with this liquidity crunch. So what I'm trying to say is, all this repo madness BS, what it's going to lead to is the bond market breaking and the treasury yields will spike. So Zoltan warns, identifying the trigger of forced sales so translated, treasury yields will spike and the yield curve will become inverted again. But this time it's really, then, the market's going to panic. Shit's going to hit the fan. All right. Identifying the trigger of the forced sales of the treasuries around year end is the Forex swap market. It goes worse. It gets worse because the sell-off that is triggered by the freeze in the Forex swap market will promptly lead to a crash in the bonds market and spread from there. Or as Zoltan puts it, these funding market stresses will likely pull away capital and hence balance sheet from equity long-short strategies, which could spill over into a broader equity sell-off. During a treasury sell-off, that's not the right kind of risk parity Christmas. Which brings us to the punchline. Number one, the dismal liquidity situation within the U.S. commercial bank sector is so dire that the shortage of reserves will start a cascade of liquidations beginning in the Forex swap market, progressing to treasuries and culminating in stocks, and a full-blown market crash. That's big. It's big. It's a big claim. And I feel like he knows what he's talking about. It is a little complicated, though. But, listen to this twice or slow it down. All right, when these pressures will show up and how long they will last is the last big question asked by Zoltan. And as he answers, here it's hard to have a definite answer. It depends on how equities do, which depends on the trade deal and other random tweets. It depends on other random tweets. It depends on Trump. It depends on how auctions go, which depends on equity market and curve slope relative to actual funding costs. Just complicated, but I get it. All right. We should note here that the next major tax remittance to the Treasury is on December 16th. Today is the 11th, so 5 days away, Monday. Oh, and tomorrow's the FOMC. So tomorrow, Powell's there's gonna be another rate decision to hold or to cut. I guarantee you they're gonna cut, and gold and silver is gonna take off tomorrow just based on that. And if the Zoltan guy is right, who used to work at the Fed and who pretty much created the repo market, right? He created it, so he should know something about it. If he's right, well, we're gonna have a nice party in the private group of MMG. In the next few months. All right. So we should note that the next major tax remittance Treasury on December 16th, it was the same September 16 tax payment that according to many triggered the repo carnage by draining tens of billions in reserves from the banking system. Will lightning strike twice and on the same day, no less than the day the U.S.-China trade deal is expected to be signed? So if the trade deal goes bad Monday, right, and the Fed lowers rates tomorrow, and the same thing happened last year. This is what caused that 20%, possibly would have caused that 20% dump in the markets at the end of 2018 into the beginning of 2019, right? Just a year ago. They're saying that's what caused it last time. But this time it's going to be way worse, and it's because the repo market broke itself. And that's because the Fed was raising interest rates. That's what really started this. It's complexity theory, guys. You can't take a free market, turn it into a centralized planned Ponzi scheme market fueled by endless credit creation, because it becomes ever increasingly complex, and this is the type of stuff that happens. Anyways, let's continue. One especially ironic development is that higher stock prices in the coming weeks will only make the matter worse. If the equity markets rallies and auctions go poorly, GSIB scores will keep going higher, and the risk that funding market pressures for managing GSIB scores will show up starting the last 2 weeks of the year and will last longer than just the spot turn are rising. Said otherwise, the dire warning from arguably the top expert on the repo market is that the adverse cascade will begin in the last 2 weeks of the year, meaning that, that's pretty specific, right? Traders have about a few days to take preventative measures. That said, there is one potential out. The Fed steps in. Year-end in the Forex swap market is thus shaping up to be the worst in recent memory, and the markets are not pricing any of this. So what he means is the Fed steps in is they come out and they have to publicly admit that they're going to do QE before the market even crashes, which is crazy. But they're probably going to wait for the market to at least dump a decent amount. This is probably why Mnuchin last year, at the end of 2018, shit himself, right? And no one said anything about the banking sector when stocks fell 20%. But he came out and, no one was even questioning anything. And he said, don't worry, guys, the banks are fine, the reserves are fine. And everyone looks around, they look at each other, and they're like, no one said anything about that. What do you mean? What's wrong with the reserves? All right, so they know what's going on. And, it's like Wizard of Oz. You pull back the curtain, and it's just this little old man moving levers up and down. There's a nice meme of Bernanke doing that, and even Alan Greenspan. All right, let's continue. Another prevailing consensus idea is that the Fed will not cut one more time in December to deliver a slope in the money market curve so that the reserves from bill purchases flow up to banks. I guarantee you they're going to cut rates tomorrow because they have to know that there's something wrong with the repo market. So they're probably reading this article because it just came out today or yesterday, a few hours ago. So they're probably reading this too. And someone's going to bring this up to his attention. And if they were going to not lower rates, they're going to lower them now. So what Zoltan is stating in not so many words is that, as has happened on every other previous occasion, the Fed will have no choice but to intervene to reverse the coming crash. Only this time, with its ammo severely limited because the interest rates on, yields are already below 2%. How much can you cut until you get to zero? There is just one thing that the Fed can do, or as Zoltan says, something will have to give, and the turn has to get very bad before something gives. But will things get very bad? Will Zoltan is right and the Fed loses control over the overnight rate complex? Yes, they will. And as we tweeted some practical advice yesterday, the Hungarians just canceled your Christmas vacation. You guys can read this tweet. It's on, Hedges Twitter. All right, the question that is, what will the Fed do? Here is Zoltan's answer. If we are right and the Fed loses control over the rates complex going into year end, not just around the spot turn, the weeks leading up into it, what else can the Fed do? Encourage foreign central banks to use the Forex swap lines. And 2, start QE4 by switching from buying bills to buying coupons. Of the two options, Zoltan believes number 2, the Fed launching QE4 is the next launching QE4 in the next few days would be the proper decision. So he's literally saying the Fed's going to start QE4 in the next few days and weeks. That's insane. QE4 would help through the back door. Just remember, a year ago to this date, they were talking about raising rates and letting the balance sheet run off and all the $4 trillion run off the Fed's balance sheet. The balance sheet's grown. It's back up above $4 trillion. QE4 would help through the back door. QE4 would reliquefy the treasuries markets. The QE4 would refill the back end shale in the instant. All right. That said, Zoltan concedes. I'm almost done. That said, as Zoltan concedes in his conclusion, QE4, as much as it makes sense, won't happen unless the Fed's hands are forced, by which he means there has to be a market crash for the Fed to do one thing that can alleviate the bank's terminal reserve problem. By the way, I'm pretty sure, like, you could speculate that when Powell met with Trump not too long ago, like a few weeks ago, or when was that? A week and a half ago, something like that. They were probably talking about this. I wouldn't be surprised. That's why they met. You only meet if they're not supposed to meet unscheduled. So they probably met because they probably know this and there's a serious problem. Guys, I mean, if you're still on the sidelines and you're not prepared financially for what's coming, I do not feel sorry for you whatsoever. And don't go to my website and get in the private group when it's late and it's volatile and the prices have already gone up and everyone else is sitting on mad gains and you're late to the party. Because those people, I'm probably going to shut it off once prices get really high, because I don't want those people coming in, because it's gonna, you're gonna get corrections, pullbacks, volatile. They're mentally not gonna be able to handle it, and because if you're dumb enough to be this late to the private group, right? For the MMG private group, if you're this late, then you're probably not sophisticated or smart enough to understand what's really happening here, and I don't want you. Like, I don't want to deal with you. Yeah, that's how I feel. So 15% off. Take advantage of it. I know everyone's Christmas shopping, but those presents aren't going to feed your family in a couple of years when things are really bad. All right. So let's finish this up. We're at the end here. That said, Zoltan concedes in his conclusion QE4, as much as it makes sense, won't happen unless the Fed's hands are forced. In conclusion, all we can say here is that 11 years ago, on September 5th, 2008, 10 days before the Lehman Brothers filed for bankruptcy, there were massive market-wide repo problems. Recall the repo market froze in September 2008. And only a multi-trillion bailout by the world's central banks prevented civilization collapse. And that's true, guys. We were like a day away from all the banks, everything just absolutely imploding, the money market funds, and, trucks stopped delivering food to stores. and there won't be gas at the gas stations. I don't know if the power will get cut off. Sure, there'll be, the military will come out and they'll provide power, but and almost nobody understood them, with one exception. Citi's Matt King did, and he laid out all the problems in his iconic September 5th, 2008 piece. This is an article he wrote like a few days prior to the shit hitting the fan. Are the brokers broken? In which he predicted the collapse of Lehman. 10 days later, he was right. Will Zoltan Pazar be this generation's Matt King? Probably. It also aligns with my prediction. For the past few weeks, I've been saying, guys, I wouldn't be surprised if this is the all-time high. Like this is it. This is it. I wouldn't be surprised. I wouldn't be surprised if because my TA is telling me that, all right? And they've been really juicing the markets just to print good revenues and numbers for these corporations for the holiday season. So the retailer keeps shopping and thinking everything's okay. So the retail investor buys a bunch of gifts and doesn't go into the MMG private group. And all right, guys. I mean, that's pretty much all I have. Smash some likes. Leave anything in the comment section. Please share my videos. It's the only way my channel grows, and I will continue to do this. Matter of fact, the only way I'm going to continue to do videos, I do enjoy doing this, but it is very time consuming. To upload a 40-minute video, it takes like 2 hours just on one channel. I have 2 YouTube channels, and then I have a couple more video channels on other platforms. By the way, the purge starts today. I am on other social media places. I'm not going to put those links in the description because they will come, go into the Telegram group. It's free. It's convenient. You could download it on your phone. You could see all the things I post in the newsroom. By the way, there's things I'm not willing to say, on video, but I do say in the groups. More truth for more pills for you guys. Truth pills. I don't want to even give it a color because I'm not a lefty or a righty. I think they're both of the same bird, right? Remember, they're the same thing. What else? I had a few more articles. Yeah, there's a bunch of repo articles. It's blowing up. That's it, guys. Go to my website, 50% off. I think I would not be surprised if gold and silver rallies in a really big way in the next few weeks and months, and then we finally have a huge correction in metals, and then the bull market is off. Let me explain to you what I'm trying to say. All right. I didn't want to make this a longer video, but let me find it. All right, here's a 12-hour chart of gold. It's still looking bullish, guys. It's just consolidating, all right? It's people like freaking out when it falls like $6. Let me show you. All right, I'm zooming out. This is a weekly chart of gold, all right? Do you know where I think we are compared to the last bull market? Okay, so here's the bull market in gold, right? It broke out in 2001 or 2000. Well, technically it broke out. Yeah, here's 2000. Here's 1999, 2000. Where was the price of gold? It was at $260. $260. Look what it did. Boom. And I called the breakout in the next bull market. How did I know? Remember, guys, my blue equilibrium line in the 200-week moving average crossing my blue equilibrium line. Remember that? I kept warning you guys for about 6 months that gold's going to go into a new bull market. Gold was around $1,200 then, which means the mining stocks went up. By the way, one of my mining stocks has gone up almost 200%, and in the past 6 months, it's gone up over 1,000%. Like, it went up 1,500%. All right, you're not going to see that shit in crypto. I'm sorry. All right, so yeah, here's my blue equilibrium line. The 200-day moving average crossed over it. Boom, bull market. Let's fast forward to today. Here's the blue equilibrium line. See it right there? The 200-week moving average crossed above it. Boom, we're in a bull market. Now, this, right? This, where the price is today for gold. Where is this if we want to compare it to the last bull market? I'm going to show you where it is. We're probably right here. I could be wrong, right? Not financial advice. But I think we're like right here. We'll get a little more upside. Huge correction. And then for the next 3 to 5 years, to the moon. All right. This is where I think we are. If you want to compare it to the last bull market in gold. So, if you buy physical metals, you're going to make some, but it's an insurance policy. Then you have to sell it, and you're probably going to be selling it with everyone else. They're going to come out with laws. You're probably going to give windfall taxes when you go to sell physical, unless you go on the black market in the dark alley. Will it make you rich? I mean, if you're already rich, yeah, it'll make you richer, and it's a good insurance. I think you should do both, physical and stocks. But stocks, if you only risk money in stocks that you are absolutely okay losing, okay? First of all. But, if you have a couple extra thousand, 10,000, whatever, and I'm talking extra, not like your life savings, you could do really well, like life changing. That's what I'm doing. Not financial advice. I could be completely wrong, right? So these are my thoughts and opinions. I just think we live in the most interesting time, guys, and you have to take it seriously. And my calls have been pretty damn good. I don't want to be famous, and it's all on the record too. So, but there's no one who called this bull market like I did, and I'm not a perma gold bug bull, right? I told you guys, like, I was swing trading this entire thing right here, entire price action right here, for the past few years, right, on video. So people who've been with me for years, they know. All right, guys, smash them likes next time.